thank you very much for the time. Delighted to be here with you. As mentioned, my name's Magee. I'm an investment specialist and part of our U.S. equities business at JPMorgan Asset Management. And excited to be talking to you today about our U.S. Smaller Companies Investment Trust. So this is, as the name suggests, an investment trust that invests in smaller companies in the U.S. We only invest in publicly listed companies, but more on the small cap side. So think in the range of 500 million to 10 or so billion in terms of market cap. So tapping into slightly differentiated companies than what you might think of when thinking about the US market. And we actually see quite a compelling opportunity set here. So over the course of the next 20 minutes or so, wanted to highlight a little bit of a look back at how US equity markets have performed over the last couple of years and some of the dynamics that are taking place. A little bit on our outlook going forward, and particularly around our outlook for the smaller cap space. I'll also touch a little bit on our overall platform and expertise, how we think about investing in US equities. And then finally touch on the U.S. Smaller Companies Investment Trust, how we think about investing in U.S. smaller companies and building a portfolio of higher quality companies that's delivering this exposure to the heart of America in terms of those smaller companies. So maybe I'll start with a little bit of a look back. On this slide, we show performance of U.S. equity markets, both in 2023 and 2024. On the top, we have that performance broken down across market cap, large, mid, and small, and across different styles. So value, core or blend, and growth exposures. Then below that, we have performance of the individual sectors across the S&P 500 in both years. Now, what you can immediately glean from this slide is quite a lot of green. We had 2 consecutive very strong years for US equity markets. Last year, the S&P 500 delivered about 25% return in US dollar terms, similar number in 2023. And we saw some similar trends across both years as well. So last year, we saw large cap outperform small cap. We saw growth outperform value. And that's a similar sort of picture that we saw in 2023. When you look at the underlying sectors, you're also seeing similar pictures across both years, with at the top some of the large mega cap names that you might expect, the quote-unquote Magnificent Seven, delivering very strong returns. In 2024, the Magnificent Seven drove just over 50% of the returns of the S&P 500, a bit lower than what it did in 2023. You also see sectors like communication services, information technology, delivering very strong returns again across the market. But one thing that we do notice is that dispersion and that strong dispersion across the market has come in a little bit. So we actually see the third best performing sector in the S&P last year was financials, after not as strong a year in 2023. And similarly, we saw utilities deliver a negative return in 2023, rebound pretty meaningfully up 23% last year. So starting to see this story of quote unquote broadening out play out across the broader US equity market. Now, given this backdrop of very strong market returns 2 years in a row, what's our outlook going forward? And as we think about the outlook for the broader US economy and for US stock markets, we think about 4 key areas: the economy, consumers, earnings, and valuations. And at the top, one thing I would say is that across JPMorgan Asset Management, we're very much focused on actively managed portfolios. We are looking to do fundamental bottom-up due diligence on individual companies and try to find those individual stocks that we think are going to outperform the market relative to the benchmark. So we're very much stock pickers, very much focused on the quality and the earnings of individual companies. We are not top-down macro traders. That said, our conversations with companies help inform our broader overall outlook on the US market, and the broader overall US market economy is influencing the companies we're investing in. So when we think about the US economy, we actually see that it's pretty strong. The US economy continues to grow above trend. We've seen the latest GDP growth numbers at about 3.1%, so pretty robust economy. We're also seeing that the US consumer is healthy. You saw in the last chart a bit of weakness in the Chinese consumer, maybe less willing to spend. Americans do not have that problem. Americans love to spend. So US consumers actually drive about 70% of US GDP. And actually a quote that I sort of stolen from our chief market strategists, you can always rely on the US consumer to spend money they don't have on things they don't need. And that has powered the growth of the US economy. So we've actually seen very resilient consumers. We've seen the unemployment rate be pretty reasonable. We've seen inflation come down. It's maybe stagnating a little bit more recently, but pretty reasonable inflation numbers, particularly relative to some of the other developed economies that we're seeing. We're starting to see a little bit of a pickup in terms of concerns around the lowest end consumer in the US, starting to see little bits of pickup in terms of credit defaults, for example. But even in a slightly higher interest rate environment, most US mortgages are 30 years in term. So they have locked in lower rates, and actually a higher interest rate environment is not leading directly to higher loan costs, loan repayment or interest costs for individual consumers in the US. So actually seeing a pretty robust backdrop for the broader markets. The next thing we think a lot about is earnings. And actually we're seeing pretty strong earnings across US companies as well. And this is where I'll bring in the idea of broadening out. So what we've seen over the last couple of years is very, very strong earnings from the quote-unquote Magnificent Seven companies, earnings growth of 30 to 50% from those companies. And actually in 2023, the rest of the market saw negative earnings growth. The quote-unquote other 493 stocks in the S&P 500 moved towards positive earnings growth last year. And actually, our fundamental analysts expect them to grow at low double digits, kind of 14% or so in the year ahead. This number actually looks even more compelling for smaller companies, and I'll get to that on the next slide. So pretty reasonable earnings growth and actually a much broader remit for the types of companies that are generating positive earnings. And we believe that a stock's price should be driven by the underlying fundamentals, cash flows, and earnings of the company. And so seeing that strength in earnings is really positive from our perspective. The last thing we think about is valuations. And valuations in the US market are elevated. So across the S&P 500, we see valuations at around 21.5 times. That's a bit higher than the 17 or so times earnings that you see as kind of a long-term historical average. So we think that if we want to see strong US equity market returns going forward, companies are going to have to deliver on earnings. And so again, that comes back to the earnings story of we see some strength there. And it also means that we think it should provide a pretty good market for active stock selection, really trying to identify those companies that can actually deliver the earnings and cash flows to drive their stocks higher. Given those last 2 points, though, I think that also makes the case for looking beyond mega cap tech and into some of the smaller companies. We've shown a couple of charts here that just give a little bit of background as to why we think US small cap is a little bit more interesting. The first on the left-hand side shows that small cap relative valuations are near historic lows. So what we've shown here is the forward PE ratio of the Russell 2000, which is the traditional index we use for small cap US equity markets, versus the S&P 500. On average, smaller companies tend to trade at a bit of a premium, about 1.3 times. You'll see parity down at one time. Currently, they're at about 1.2, so a little bit less expensive relative to US large cap. Similarly, on the right-hand side, you'll see earnings growth expectations for smaller cap companies. And one of the challenges, if you look back into 2022 and 2023, those numbers in blue are for the Russell 2000. And smaller cap companies weren't generating strong earnings. They struggled through the pandemic, as large cap companies did as well. Mega cap led that earnings rebound out of the pandemic. Now the rest of the large cap is getting there too, and actually our expectations for smaller companies are much higher going forward. This is the expectation on the street, so about 26% increase in earnings per share. Our estimates, maybe not quite that high, but still a pretty reasonable rebound in earnings coming from smaller companies. Now, just to give a little bit of background on our overall platform before I get into the specifics of the investment trust, I've shown here our overall global and US equity platforms within JPMorgan Asset Management. Across the firm, we manage over $1 trillion of actively managed global equity portfolios across the US, Europe, emerging markets, and global strategies. Within the US, we manage about $725 billion of assets, and that's broken down into three key areas. In the blue, we have our core platform, so think S&P 500-like core strategies, and we also have some options-oriented strategies there that might provide either additional income or downside risk hedging. We also have a dedicated growth platform, about $240 billion in assets, and a dedicated value platform, which makes up about a quarter, a fifth of our overall AUM. We think this is really important because each of these different styles goes through cycles. Growth, value, small cap, large cap, they can go through different cycles at different times. And we want to make sure that we have a very diverse and robust business so that even when a style is perhaps out of favor, we can continue to invest in the people, in the resources we need to deliver alpha for our clients. And so across the platform, we have more than 80 fundamental bottom-up research analysts based around the globe. We spend more than $150 million on research every single year. And so really understanding the companies, the fundamentals of those companies we're investing in, we believe drives alpha and delivers better performance for our clients. Specific to this investment trust, I've shown the portfolio management team here. We have a team of 3 dedicated portfolio managers. So Don San Jose is the lead portfolio manager. He's been managing money in the industry for more than 25 years. He's responsible for managing small cap portfolios and is also the CIO of our broader value platform. Partners very closely with Dan Persella and John Brockle. So Don, Dan, John, we have quite a little bit of a trend there, three-letter names to be a small cap PM on our team. But you can see both Dan and John have been working together for 17 years at JPMorgan, both in the industry for at least that long. Both of them actually come from an analyst background and are analysts themselves. So when it comes to investing in small cap companies, we really want to make sure we know those companies, we're meeting with management, we're understanding what they're doing. And so having this analyst expertise, they also have a dedicated team of research analysts that help support them. And fundamentally, we believe that it's important to invest in high-quality companies. So we're looking to invest in high-quality US small cap companies. Our benchmark is the Russell 2000 index and aiming to outperform that index over time while providing a core exposure to the small cap space. We'll invest in a portfolio of 70 to 100 holdings, generally leaning into higher quality companies, so generally tending to have a higher ROE than the benchmark, as well as a bit of a higher earnings per share growth. We think that this helps us provide a smoother ride over time and also generate outperformance. So how do we think about investing in companies? Well, you'll see that quality focus feeds through here as well. There's really 3 key things that we're looking for. First, we're looking for high-quality businesses. So when we're looking at US smaller companies, we think that offers a tremendous opportunity for growth in the future, investing in smaller companies that can grow over time. One of the challenges, though, is that small companies do come with volatility, and actually about 43% of the Russell 2000 index generates no earnings today. They're not profitable yet. Fair enough, that's what you get when you invest in smaller companies, but we really want to focus in on those high-quality businesses, generally those that are generating earnings, durable business models, consistent earnings, and a key competitive advantages in their space. We're also very much focused on the management team. Again, we want to know the people that are managing the companies we're investing in because there isn't that much buy-side or third-party research out there. We need to go and understand those companies ourselves, meet with the management teams, and understand what they're doing without having the same ability to rely on broker research or other third-party research. And then importantly, we're also thinking about valuation. So we think valuation is also critical here, looking at metrics like price to earnings, free cash flow yields, enterprise value sorts of analyses, really looking for high quality companies at a reasonable valuation. And we actually think that the US smaller company space offers you the opportunity to invest in lots of exciting and differentiated business models as well. I think often when people think about the US market, they think only about mega cap tech. And yes, that's an important driver of US equity market returns, but you can find really interesting companies in the smaller cap space as well. So thought I would use this slide just to highlight a couple of ideas that we're owning in the strategy and where we see opportunity going forward. We've broken those down into 4 areas, so technology, industrials, the consumer, and financials. And just on here, in the technology sector, again, when you think US markets, you think mega cap tech. There's actually quite a few exciting smaller companies that are also focused on the technology sector. So we have Qualys, the first one there, which is a cybersecurity firm. We have Workiva. This is a cloud-based kind of reporting software that individuals or companies can use to report on things like ESG or other different metrics. And then Novanta, they're a designer of kind of laser and motion-based security that's used in the medical as well as manufacturing fields. So quite innovative technologies that are maybe a little bit smaller in terms of market cap, but delivering really exciting ideas that are going to spur the economy going forward. The industrial space is also really important. Industrials actually makes up the biggest portion of the Russell 2000 in terms of individual sector weight. Not surprising, like a lot of the types of smaller companies you see across America do tend to be a little bit more industrials oriented. This is an area that's been a little bit more cyclical, but an area that we still have conviction in because of the ability to invest in high quality companies. So for example, we have Hayward Holdings. This is a pool equipment company. So if more and more individuals are going out and using pools or building them around their houses, this could spur investment in that area. Simpson Manufacturing is involved in providing materials for construction companies. And the Toro company does turf and landscape. So all kind of tapping into that idea of reasonably strong growth in the US economy, needs inputs to support that growth. In the consumer space, we're also finding opportunities. So BJ's Wholesale Club is kind of like a Costco, which I guess we don't have here either, but it's a large kind of like a warehouse club where people can buy discounted groceries, televisions, paper products, those sorts of things. And then Fresh Pet, you can guess, does pet food that's fresh for cats and dogs. And then finally, financials. Financials, as I said, actually a sector that's performed reasonably well over the last year. Again, not a huge part of the smaller cap space, but we're finding some opportunities here. Kinsale Capital Group being a specialty insurance firm, and Moelis being a smaller investment bank. One other area you don't see on here is healthcare. A lot of the smaller companies in the healthcare space tend to be biotech firms. That's not an area that we invest in the portfolio. Biotech comes with a lot of potential upside, but a lot of potential volatility as well. And given our high quality remit, we haven't found as many companies in that space that we have as much conviction in. So probably an area that we generally tend to be underweight in the portfolio, but really finding lots of opportunities, both from a consumer perspective, an industrial perspective, tech, financials, kind of across the board. So maybe I'll just kind of wrap up with a final summary. This investment trust, as I mentioned, invests in kind of 70 to 100 holdings, looking to invest in high quality US smaller cap companies, those that we think are going to drive the US economy going forward and should be supportive by the broader macro backdrop. So with that, I will wrap up and take any questions.
Thank you very much indeed. Thank you. Okay, then, take for questions. We have one here straight away, please. Thank you.
Yes, I mean, last year there were some popular trends. For example, AI, cybersecurity, quantum computing. Do you see any particular trends for next year that's going to cause temporary or slightly longer surges in share prices?
Well, I think there's certainly an element of when you're investing in smaller cap companies, you can have a bit of market volatility that comes through things like meme stocks, or towards the end of the year, you saw a really big rally in quantum computing, and then the CEO of NVIDIA kind of dismisses it, and most of their share prices go straight down. So I do think that's an area that this portfolio will tend to underperform if you see a large, quote unquote, meme stock type rally. So I think there's always an element of that going on. One trend that I do think we're starting to see a little bit more of is, I suppose, always the question of M&A. M&A is certainly a part of the smaller cap space. We saw, I think, 4 of our companies last year get bought out. And so that's something that we find quite compelling. I mean, that's certainly a compelling investment opportunity in the smaller company space. We think that's been picking up a little bit, and probably a little bit more, maybe a broader shift towards deregulation might be supportive of that as well. So perhaps that's a theme we could expect to see a bit more of in the year ahead.
Question towards the back, please. Thank you.
Thanks for your presentation. The US market has performed really well over the last 2 years. I think you said over 40%. And is expected to grow again over the next 2 years. Do you see any risk at all to investing in the US, from government debt or bond yields going up too high?
Yeah, so since the trough in October 2020, the US market, the S&P, is up more than 60%. I think we are cautiously optimistic. In general, we see a supportive backdrop for the US economy. We see supportive backdrop for company earnings. A couple of concerns out there, though, are certainly policy risk and headline risk. So sometimes, even if we think individual company fundamentals are strong, potentials around different headlines coming around and the uncertainty around how new policies might be rolled out, we do think presents a risk. And that's one that we're spending a lot of time thinking about. What potential risks in terms of our relative bets are we taking through that? We also do see interest rates as a broader risk, particularly for small cap companies. So small caps after the US election in November outperformed large caps by about 18%. They did give a lot of that back, actually, because the 10-year interest rate rose by about 80 basis points in the fourth quarter. Small caps overall, the beta of the market has tended to do better when interest rates are going down. But actually, we've also seen that small caps perform quite well when interest rates are stable. So just having a little bit more stability should be beneficial for the small cap space. That's also, I think, why we've tended to focus in higher quality companies. So most of the companies that we're investing in the portfolio are not the ones that are reliant on funding and going to need to go out and get funding at higher interest rate numbers. But you'll still have the broader headwind towards the beta of small cap through those interest rate pieces. So I think we're definitely cognizant that we'd expect potentially a little bit more volatility. I don't think we're expecting another 25% year from the US market. Do we think US markets go up relative to where they are now by the end of the year? Probably, or yes, but it might come with some volatility along the way.
I had a question that the last presenter spoke about tariffs.
Yes.
And if tariffs are introduced, what do you think that might mean for inflation in the US, and what the knock-on for that would be for your portfolio? Yeah, so we do get lots of questions on Donald Trump and what the new administration might bring to the market. Tariffs is certainly one of them. I think across the board, tariffs are something that we don't think would be great for the broader economy. It probably will lead to a little bit higher inflation. We think that smaller cap companies are probably a bit more immune because their supply chains tend to be more domestically based relative to larger cap companies. But again, that's an area that all of our research analysts have gone line by line through their companies. How much are they exposed to, or how much of their supply chain is coming from different parts of the world? So one we're looking at, but also a little bit of uncertainty there. And I guess we'll have to see how that plays out. Not exactly your question, but another thing we do get asked quite a lot about is taxes. So there is talk of lowering corporate tax rates in the US market. Again, one that could be potentially a little bit more beneficial to smaller companies because smaller cap companies tend to pay a higher corporate tax rate than larger cap companies. But all of this is a little bit uncertain right now, and we're trying to stick to understanding the fundamentals of the companies we're investing in. and kind of seeing how it goes from there.
Other questions for Katie, please? Question here. Yes, thanks, Steve.
Hello, this is a question about passive versus active investing, really. So there's been a multi-decade trend from active to passive, which is generally means market capitalization weighted, which means a lot of money. For most people, it means S&P 500, which means a lot of money going into the biggest companies like the Magnificent Seven. Do you see this creating this weight of money? Obviously means it's difficult to outperform investing in smaller caps. But do you see this? Do you see some sort of situation where this becomes unstable and the trend reverses between passive and active?
I think we've definitely seen that trend, and I think there are reasonable reasons for it. I mean, it does mean less due diligence, more scale potentially. We've also, across our platform, been able to deliver strong alpha. So many of our strategies have delivered top quartile performance, very strong alpha across 1, 3, 5, 10-year time horizons. So we actually think the opportunity to generate outperformance still remains. But we also think that a lot of our clients are starting to think about that perhaps unintended growth bias of their passive investments, of just by continuing to reinvest in the S&P 500, you're getting more and more growth exposure. And actually, should they be thinking about balancing out some of that risk, maybe through a value exposure, or maybe through tapping into some of these smaller cap companies that have a little bit of a differentiated profile. And so actually that's a pretty common question that we're getting from clients on how do you think about balancing this out? I'm not sure equal weight is necessarily the way to go. There's definitely a reason why larger cap companies are as big as they are, and actually the profitability and growth that you're getting from there, that is compelling. But clients are thinking about, like, have I maybe ended up with a bit of an unintended risk just by investing passively, and how could I invest either actively or through a different exposure to help balance some of that out?
Okay, and if I can ask another question.
Sure, I'll come to you next.
Yeah. So do you see a risk that larger companies will have a lobbying advantage under the current US government, where they have more money to spend on lobbying and therefore gain a greater advantage?
I think that lobbying is certainly a reality in the US. I think large companies have always had an advantage. I don't think that's really going away. There are maybe ways that smaller companies can amalgamate to tap into that as well, and lots of policies aren't necessarily just targeted at individual companies. But that's certainly a reality of the marketplace, probably not something dramatically different in this administration than previous ones.
Question here? Yeah.
Thank you for a very good presentation. When you're old and wrecked like I am, you tend to have a portfolio that has stabilised over time, for good or ill, and don't have new funds. So if you're going to buy JUSC, then arguably one's got to sell something else. Something that struck me from the figures that I looked at was that my main investment in this area is Artemis US smaller companies, clearly a unit trust rather than an investment trust, which over the last 5 years, and I've held it for somewhat longer than that, has returned 69%, where your fund has returned 44%. Things don't always remain the same. And I note that the comparative performance of the two shows a significant acceleration in your performance in the last 3 months, where, again, according to the figures I have, you've increased your value by 21.23%, where Artemis has gone up by 13%, and that makes me think, is this an inflection point for change? Part of the 21.23 would be a closing of the discount, which has been notable recently. But has there been any particular factor or range of factors that have influenced your performance over the last 3 months? Or has there been a change of strategy that happens to have generated that you'll be carrying forward into the future?
So, has there been a change in strategy? No. We continue to be invested in high-quality companies at reasonable valuations. I would say the market over the last 3 months for U.S. smaller companies overall has been a little bit volatile. We actually saw really strong results coming out of the US election. We saw that come down a little bit as interest rates increased. We saw our portfolio lag a little bit, again, coming back to some of the earlier questions, not investing in some of the really big AI trends, so supermicrocomputer being a name that performed very, very well. But as some of these quantum computing stocks have lagged year to date, actually our performance has kind of outperformed the broader benchmark just over a year-to-date perspective. So I think overall, our focus on higher quality companies should be a little bit more resilient to external factors or macro factors like higher interest rates or potentially policy decisions. But I think one of the things that we're thinking about is not short-term investing, much more investing through the cycle. And we think that investing in higher quality companies gives you a more robust, less volatile performance, but still gives you that core access to the smaller company space.
We've got time for one final question here, please. Thanks. Yeah, we haven't got time.
Is the Russell 2000, is the Russell 2000 your performance benchmark?
Yes.
What are the principal differences between the portfolio at present and the benchmark? You've mentioned biotechnology.
Yep.
But I imagine there are other sectors as well where you are under or overweight.
Yep, so in general, our portfolio tends to be a bit more invested in industrials and a bit less invested in healthcare. Other sector exposures are marginal. We had been a little bit more underweight energy. We've brought that a bit closer to neutral. And then I think overall, we would expect our portfolio, again, about 70 to 100 holdings versus the 2,000 in the index. We generally have a much higher ROE relative to the benchmark. We have a much higher in terms of percentage of companies that are generating earnings relative to the benchmark and higher kind of EPS growth. Price to earnings ratio is pretty similar to the underlying benchmark, maybe a little bit lower given our focus on valuation.
Is yours a quick question over here? There's one final. Is it a quickie? Pass the microphone back, Ed, please. Thank you very much.
The companies that you invest in, how long do you give them to perform?
In general, this tends to be quite a low turnover strategy. So we generally tend to try to find companies that we're happy to own through the cycle. So you often see us maybe trimming or adding on the margin, but we'll tend to hold companies for 3-5 years, quite a long time, rather than some of our other strategies, which can be a little bit more high turnover, particularly maybe in the growth space. But this is a bit lower turnover strategy.
Katie, we're out of time. Thank you very much indeed for coming.
Thank you.